Hi, in this video we shall see some common mistakes you must avoid when investing in equity mutual funds. Welcome to FINDAS, a place where you can be financially bindas. This is Samir Machwe and I am going to help you create abundance in your life. If you are new here, I would like to inform you that we are doing this series of videos on common investor mistakes in equity mutual fund investing. Do subscribe to this channel if you want videos related to financial management and similar topics. I have already published 6 videos in this series in the last few weeks. If you haven't watched them yet, I recommend you do so as soon as possible. I am sharing the links of all those videos in the description below. This is the last video in this series that I am presenting to you today. In my last video, I had made a promise to all of you that I am going to share with you some very interesting data of more than 20 years. I had also said that this data will prove to you that equity mutual fund investing is probably the best asset for investing your hard-earned money. In this video, we are going to see exactly this data. Plus, we shall also see that if you avoided all the investor mistakes that I spoke about in the previous videos, what kind of money you can make by investing in equity mutual fund. And let's start right now. In our video series, we saw 6 investor mistakes till now. The first mistake was to use emotions to make the decisions instead of logic. The second mistake we saw is to stop your SIPs during the market correction. The third mistake we saw was that investors make risk too significant and as a result choose to avoid it altogether rather than managing the risk. Getting panicky and exiting your investments when they are performing very badly for a short term was the fourth investor mistake that we saw in this series. The fifth mistake is trying to time the market. And the final mistake, the sixth one, is investing in equity mutual funds with a trader's mindset, looking for short-term profits. Now that we have summarized the whole series here, we shall now see where many of the equity mutual fund investors have made one or more of these mistakes in the last 20 years. If you are watching this video and you also invest your money in equity mutual funds, I recommend you do some introspection at this point. Check out with yourself if you have been guilty of making any of these mistakes that we just spoke about. If yes, it is time to learn the lesson and move ahead. I will show you what kind of money you can make by investing in equity mutual funds and avoiding all these mistakes that the common retail investors make day in and day out. Let us now look at some of the real data. This is the data for the last 20 years. I created this data in the month of December 2019 and I selected all those funds which had completed their existence of minimum 20 years till the month of November 2019. So the data we are going to see here is for the SIP started in these funds since November 99. I am leaving a link in the description below from where you can download this data for yourself. If you see this data now on your screen, let me make a few things clear before we begin our analysis. This data assumes a monthly SIP of rupees 10,000 started in the month of November 99. There are 25 equity mutual fund schemes in which this SIP could have been started and all the scheme names are available in this data. In these 20 long years, equity markets have seen many corrections like the IT bubble in the year 2000, the 9/11 attacks in the year 2001, the global market crash of 2008 and the demonetization in 2016, just to name a few important ones that I remember right now. Let us now start our analysis of this data. Assume that there are 100 investors who started their SIP of 10,000 rupees in November 99. Let us see what was the situation 1 year after the investment was done. At the end of first year, 24 out of these 25 schemes listed here had given negative returns, and the average return was minus 31.33% CAGR. With this kind of losses in the first year of investing, 25% of these 100 investors are likely to quit at this stage. These are the investors who make the fourth mistake we saw in our video series, that is of getting panicky in bad markets, and also these are probably those investors who have invested in equity mutual fund with a trader's mindset looking for short-term profit. This is the sixth mistake that we saw in our previous video. In case you are not following what I am saying right now, you need to go back and watch my previous 6 videos on the subject of common investor mistakes in equity mutual funds. I have shared the links of those videos in the description below. Let us now see what happens in the second year. At the end of second year, 25 out of 25 schemes have given negative returns, and the average returns that the investors got is minus 26.85% CAGR. This is the crucial time when most investors will start getting jittery. They start feeling like they have been cheated, their money is invested in the wrong asset, and all those negative feelings. This is your emotional brain taking charge of your logical brain slowly. Another 25 of the remaining 75 investors will surely quit at this stage. Most investors now make a decision to stop their SIP if they haven't already exited. Since the market are not performing, I will not invest now. Let's stop putting additional money and wait for the markets to recover. This is what they think. It is just like Sachin Tendulkar not willing to bat because the pitch is bad and his team has lost too many wickets too early. I hope you see the cryptic logic here. The third year arrives and the situation is only slightly better. At the end of third year, we now have only 50 investors still continuing to invest. 20 out of 25 schemes have given negative returns even after 3 years, with an average return at minus 7.33% CAGR. For most investors, their patience would not last beyond this point. Now they are convinced that it was a big mistake to invest in equity mutual funds. They would redeem everything, book a loss, and vouch that they would never ever invest their hard-earned money in equity mutual funds. They are angry, frustrated, depressed, and filled with guilt of losing money. Most of us are not equipped to handle these emotions and give in to them. This is the point where investors make risk too significant, confuse volatility with risk, and let the emotions take decisions for them. All those mistakes that we talked about in detail in our video series. Remember that? Statistics tells us most equity mutual fund investors quit between the third and the fourth year after starting their investments. And they have a very strong and valid reasons to do that. Let us do a quick recap of how actual investments fared till the third year. In the first year, the total investment was rupees 1,20,000, against which the valuation at the end of the year was 98,648 rupees. Means there was a loss of capital. At the end of the second year, having invested 2,40,000, the investor valuation was standing at 1,77,447. Again, a major loss in capital. None of us likes to see our money losing value. This loss is notional until you redeem your money and make it real. But your emotion brain will start playing games with you even though this is not a real loss. You need to shut up your emotional brain, else it will take control of your life. After the third year, the investment is now 3,60,000, considering that a few investors continue their monthly SIP of rupees 10,000. The valuation at the end of 3 consecutive years of negative returns is rupees 3,24,180. Most investors cannot take it now. 3 years of investing, my capital is still negative. This is not working out. I cannot take this any longer. I have been duped. That is your emotional brain talking to you in the third year. Most people listen to this chatter inside their brain and then quit. Out of the 100 investors, 90 to 95% have already quit at this stage. This is what is the fate of majority of the investors who invest in equity mutual funds without understanding the basics and without learning about the investor mistakes that we have been talking about in the earlier videos of this series. Just about 5 to 10% of the investors who have been continuing their SIP even after the third year do so out of great conviction they have in the equity mutual funds and also because they have a very long-term outlook. These are the smart investors who are not looking for just the appreciation of their money. Rather, they are here to create long-term wealth which most people cannot even imagine. Let us now look at our data again. Now we see what happens at the end of 5 years. None of these 25 funds is now giving negative returns. 100% of the funds are giving positive returns at the end of 5 years, and the average returns now stand at plus 30.49% CAGR. This also means that the total investment of rupees 6 lakhs done till date is now valued at 12,80,000. The money has more than doubled in 5 years, which is the threshold most investors never reach. Unfortunately, this is a very small percentage of investors who actually stay invested to see the light of the day. Hereafter, for every investment horizon of 10 years, 15 years and 20 years, 100% of the funds have given positive returns. The investor money has now been growing by leaps and bounds without any additional losses. After 10 years, an investment of rupees 12 lakh has grown to 51.47 lakhs with the money working at 26.97% CAGR. After 15 years, an investment of 18 lakhs has grown to rupees 1.14 crores with a return on investment averaging at 21.7 CAGR. Now this is the great wealth creation for the retail investor. At the end of 20 years of continuous investing every month through the thick and thin, the total investment of 24 lakhs has grown to rupees 1.76 crores and the return on investment is 17% CAGR. Now this is what I call the power of compounding and the beauty of investing in equity mutual funds through one of the best mechanisms ever invented by the mankind, that is the SIP. It is very simple and probably this is the primary reason why most investors don't take it seriously. After having seen this data so far, if you won't stick to your SIP for long term, even God cannot help you. We saw through 20 years of data that humongous wealth can be created by following a simple plan of action of investing in equity mutual funds. Most of us cannot sustain a plan of action and hence we fail. For creating wealth through equity mutual fund investing, you don't need to be smart. You don't need any knowledge of the markets whatsoever. You don't need a lot of money also. What you need is only discipline. You probably need a guide, a financial planner who brings you back on track whenever you lose focus, which will happen every once a few years. I would like to take this opportunity to bring forth a few important aspects of equity mutual fund investing through my experience of more than 20 years now. The equity mutual fund investing is very simple and hence well suited for the small investor or for the retail investor. It also beats every other asset class like gold, silver, real estate and fixed income instruments like FD and PPF over the long term. You can check the data for yourself for other asset classes too. It is also one of the least taxed asset classes out of all. It requires little money to begin with. You can start at as low as rupees 1000 per month. It is very flexible yet gives you high returns. You can invest monthly or as and when required in lump sum amounts. It is volatile, but you can still sail through all these ups and downs with the help of a proper financial expert. With all this data, I believe now you understand that equity mutual fund investing is the best investment vehicle for your money if you are in the game of creating long-term wealth. At FINDAS Consulting, we have been helping our clients to create wealth since the year 1999. We help them live a financially abundant life and reach all their financial goals with ease and grace. We have time-tested scientific process which you can check out for yourself on our website findasconsulting.com. I am sharing the link in the description below. I hope you have understood the investor mistakes to avoid in equity mutual fund investing and also how you can create great wealth by a disciplined approach over the long term. Please subscribe to this channel and turn the notifications on so that you don't miss any of our regular updates. I post a video every Sunday on various topics like investing, money management and wealth creation. Do follow us on Facebook, Twitter and Instagram. Check out our website findasconsulting.com to find out more about the services we provide to create abundance in your life. Thanks for watching and I'll see you next time.